In the dynamic world of finance, the strategy of buying and holding stocks for the long term unveils a multitude of advantages that can significantly impact investors' portfolios. Beyond the immediate gains, embracing a long-term perspective opens the gateway to the powerful force of compounding. Over many years, this compounding effect has acted as a catalyst, amplifying returns for astute investors who choose to navigate the market waters with patience and foresight. The companies and stocks we will talk about today each boast distinct advantages, setting them apart as stalwart contenders for enduring investment success. So without further ado, let's dive straight into the top picks. First on our list is Realty Income, a stalwart player in the realm of real estate investment. Strategic exposure to the real estate market remains a key tenet of a well-diversified portfolio. Realty Income distinguishes itself as a real estate investment trust, a designation that entails the obligation to distribute at least 90% of its taxable income as dividends to shareholders. In a testament to its commitment, Realty Income proudly dons the moniker the Monthly Dividend Company, underscoring its reliable income distribution. At present, its dividend yield stands impressively at 4.9%. Operating across a diverse array of 85 industries, Realty Income strategically leases properties to clients. Notably, the company's focus gravitates towards sectors resilient to economic downturns, fortifying the security of rent collection even in the face of potential recessions. This strategic approach has yielded substantial success, with Realty Income boasting a commendable 13% compound annual return since its emergence as a public company nearly 3 decades ago. As we gaze into the future, the prospect of Realty Income stands as a beacon for investors seeking enduring stability and robust returns in the ever-evolving financial landscape. Now, it's worth turning our attention to Etsy, a platform that may have played a significant role in the quest for unique and heartfelt gifts. Etsy's distinctive two-sided marketplace serves as a nexus, seamlessly connecting sellers crafting handmade treasures with buyers on the lookout for gifts that exude individuality. With a staggering 97 million active buyers and 8 million active sellers presently populating its platform, Etsy has firmly established itself as a go-to destination for those seeking one-of-a-kind creations. In the recently disclosed financials for the third quarter of 2023, Etsy showcased a noteworthy 19% year-over-year surge in active sellers, coupled with a 3% uptick in active buyers. While the company aspires for an acceleration in both these metrics, the Q3 results mark the third consecutive quarter of enhanced growth. This trajectory hints at a potential uptick in interest and engagement within Etsy's bustling marketplace, indicating that the platform's allure might be gaining momentum. Despite its burgeoning appeal, Etsy is currently trading at a valuation of only 4 times its sales, making it a remarkably affordable investment option. This valuation positions the company nearly as attractively priced as it has ever been, thereby affording investors an impressive margin of safety. In the intricate tapestry of market dynamics, Etsy emerges as a compelling opportunity, where affordability converges with the promise of renewed growth, beckoning investors to explore the potential rewards within this unique marketplace. Next, we have Amazon. While Amazon has been a historical triumph for investors, the recent years have witnessed a somewhat subdued performance, failing to evoke the same exuberance as its earlier chapters. Over the last 3 years, Amazon's stock has experienced a modest decline of 3%, a notable contrast to the robust 28% return delivered by the stock market benchmark during the same period. The narrative of this underperformance finds its roots in the complex dynamics of the pandemic, where Amazon, in response to surging demand, swiftly expanded its distribution network, only to recalibrate once spending on its platform returned to a more normalized state. The silver lining in this story emerges as Amazon appears to have regained its stride. The third quarter unveiled a remarkable operating income of $11 billion, representing a staggering 343% surge from the corresponding period a year ago. This impressive turnaround is primarily attributed to the resurgence of Amazon's e-commerce business, which had grappled with operating income challenges in 2022, but has since orchestrated a steady reversal throughout the year. This resurgence in operating income underscores Amazon's adeptness at adapting to dynamic market conditions and strategically navigating the complex e-commerce landscape. As the e-commerce giant steers back on track, investors are poised to reap the benefits of Amazon's resilience and strategic prowess, once again positioning it as a formidable player in the ever-evolving realm of online commerce. In the expansive realm of tech giants, Apple stands out not just for its iconic devices, but also for a strategic evolution that positions it as a compelling long-term investment. While Apple's ubiquitous devices have undoubtedly contributed to its widespread success, the key to its future returns over the next 2 decades lies in an unexpected domain, which are its services. Boasting a staggering user base of over 2 billion active devices globally, Apple has carved a niche for itself in the tech landscape. Remarkably, it is their services segment that is emerging as one of the company's fastest-growing domains. This segment encompasses a suite of subscription products including Apple Music, iCloud, and Apple TV+. In the fiscal year 2024, which concluded on September 30th, the services segment witnessed a robust revenue growth of 10%. Even as Apple encountered a 3% dip in overall revenue in fiscal 2024, the services segment's contribution has played a pivotal role in bolstering the company's gross margin, witnessing an impressive increase of 80 basis points. This underscores the strategic pivot towards services, wherein Apple not only diversifies its revenue streams, but also taps into the higher profitability inherent in this domain. As the tech landscape continues to evolve, Apple's foresight in emphasizing services as a growth engine positions it as a resilient and forward-thinking investment. With a robust foundation of active devices serving as a catalyst, Apple's services segment becomes a key driver for sustained growth, setting the stage for a promising trajectory over the next 2 decades. Investors looking for a blend of innovation, diversification, and profitability may find Apple's strategic shift towards services an intriguing narrative for the long-term journey ahead. In the dynamic realm of e-commerce, Shopify stands as a linchpin, empowering the digital storefronts and intricate mechanics that drive the operations of numerous businesses. Renowned for its role in helping companies, irrespective of size, streamline their logistics, Shopify has solidified its status as an indispensable player in the ever-evolving e-commerce landscape. In the wake of the pandemic-induced surge in demand, Shopify experienced a period of inflated revenue growth, a trend that has seen moderation as the business gradually normalized. However, a closer look at the most recent quarter paints an optimistic picture, indicating a trajectory aligned with positive momentum on both the top and bottom lines. During this reported quarter, Shopify witnessed a noteworthy 25% year-over-year increase in revenue, underscoring its resilience and adaptability in a rapidly changing market. Notably, the company's gross margin witnessed a substantial improvement, marking a commendable 410 basis points increase. The positive shift in Shopify's financial performance reflects strategic resilience and an adept response to the evolving dynamics of the e-commerce landscape. As the company successfully navigates the normalization phase post-pandemic, its ability to generate positive operating and net income underscores a fundamental strength and adaptability. Next, we have PayPal Holdings, a prominent player in the fintech sector, which experienced a remarkable surge during the pandemic, reaching an all-time high closing price of $308.53. However, the current landscape paints a different picture, with the stock witnessing an 80% decline, settling at $62. Founded by Elon Musk and having undergone the eBay acquisition before being spun off, PayPal has grown into a reliable online payment platform. Notably, the company holds assets such as Venmo, actively working on capitalizing on its potential. Navigating through competitive waters, especially against contenders like Apple Pay, PayPal's revenue trajectory defies industry expectations, displaying consistent growth. Analysts project a promising outlook, anticipating an 11% increase in EPS for 2024 and a substantial 13% for 2025. By examining the financial metrics, a 2024 EPS of $5.53 per share positions the stock as undervalued, boasting an 11.2 earnings multiple and a PEG ratio of 1. This presents a compelling investment case, earning PayPal a buy recommendation in the eyes of financial experts. Lastly, we have NextEra Energy, which operates as a utility company, comprising a regulated segment and a resources segment. The regulated utility arm is distinguished as America's largest utility company, underscoring its substantial size within the industry. Despite a recent decline of nearly 30% in the stock over the past 12 months, such a performance aligns with the broader trend in the utility sector, which has faced challenges in 2023 due to elevated interest rates and the perceived income-centric nature of utility investments. Functioning as a dividend stock with a current yield of 3.1%, NextEra faces heightened competition in a high-rate environment where income considerations are paramount. Beyond the income aspect, the stock exhibits growth potential and is currently valued attractively, presenting an enticing risk-to-reward proposition. Trading at a favorable valuation, the stock's appeal is accentuated by a positive outlook, with analysts forecasting an earnings per share of $3.40 for the upcoming year. In summary, NextEra Energy operates as a prominent utility company with 2 primary business segments, namely a regulated utility arm and a resources segment. Essentially, just one of these branches was enough to give them the title of America's largest utility company. This company is positioned as a strategic investment in the context of the burgeoning renewable resources sector. To stay informed about the best stocks to buy, then press the like button and subscribe. With that being said, I wish you the best of luck and happy investing.